Good morning, everyone. Thanks very much for your patience. Welcome to today's webinar. My name's Alex Paul from InvestorStream, and I'll be your host today. Today we have AXP Energy Non-Executive Chairman Simon Johnson and Non-Executive Director Sam Jarvis, who are going to provide an update on the company's progress for the quarter ending 30 June. Following the presentation, both Simon and Sam will address any questions you may have, and we'll attempt to get through as many questions as time permits. Please feel free to send in your questions via the chat platform in the question pane in the GoToWebinar control panel. You can also email them to me at alex@investorstream.com.au. You can also download a copy of the presentation by navigating to the handouts pane in the control panel. And finally, a copy of the webinar will also be available on AXP Energy's social media platforms later today. But for now, I'd like to throw it over to Simon, who's going to kick things off for us. Simon, the floor is yours.
Thank you, Alex. Okay, well, good morning, everyone. We appreciate your interest in AXP Energy, and we'd like to thank you for your faith and support in our stewardship of your invested funds in the firm. I'll walk us through the presentation, and then, as per Alex's comments, Sam and I will address the questions that you put to us via the web portal. We believe that better communication and improved transparency is an area for improvement, and we trust that you will see today as a firm step in that direction by the management team and board. Next slide, please, Alex. So you'll find here our safe harbour statement, and we would like to remind you of the limitations that we place on the information that we're providing to you today. We encourage you to consider the risks inherent in investing in AXP Energy and seek professional and independent advice when considering your current and future positions in the stock. Throughout this webinar, we will be making forward-looking statements which you cannot and should not rely upon. They're provided for information purposes only. We've used our best judgment in sharing our plans and outlook with you in good faith, but they are subject to change, and we're working in an increasingly uncertain business in uncertain times, and neither Sam nor I are Nostradamus, frankly. So next slide, please, Alex. So what we're going to do today is run you through the quarter. We'll give you some colour on what has transpired and how the business is evolving. We'll have a steady stream of news to share in coming days and weeks and months, but for this presentation, we'll be focusing on what has happened in the past 3 months. As per our recent disclosures, we've recorded 150% improvement in net revenues in the second quarter, and we almost doubled the volume of oil that we sold to our downstream partners. Our inventory ended at similar levels to where we started, but that camouflages the material increase in volumes delivered to refineries. Gas is the bedrock of our new business model, and we had a rough quarter in terms of what we sold into the pipeline and also related near gas liquids. Our ending cash position drew down on where we finished in the preceding quarter, but we had significant payments to make related to our Magnum Hunter production and TREY acquisitions. We'll have another payment of approximately Aussie dollars 425,000 to make in relation to TREY in the final quarter of this calendar year, and then we will have satisfied all monies due under our sale and purchase agreements, for those assets. Next slide, please, Alex. So here's the story of our fortunes through the quarter. We saw strong development of pricing on both the gas and the liquids front. We previously shared with the market our successful efforts to negotiate sales pricing where possible. However, we also saw some significant impact by factors mostly outside our control in terms of our ability to deliver sales volumes that we had at our disposal. So in summary, the improvement in underlying commodity prices and volume of oil delivered through the quarter was somewhat undermined by a reduction in gas sales value due to outages in our downstream supply chain. As you know, oil and gas, particularly when you're feeding off-takers with occasionally misaligned commercial goals, can be a challenging balancing act. So we experienced great pricing development on a per unit cost, but suffered in terms of the volumes that we were able to sell through no fault of our own. So let's dig into the detail of that a little bit. Next slide, please, Alex.
So we might hand it over to the non-executive director, Sam Jarvis, who might be able to provide a bit more colour on this slide. Sam, if you want to come off mute, do you want to take over for us?
Yeah, sure. Apologies. Can you hear me okay, Alex?
Yes, I can, Sam. Thank you.
And we're on slide 5, the quarterly production summary.
Yes, that's correct.
Okay. So just following on from what Simon said, we communicated to the market that when we hit the 2,300 barrel of oil equivalent, which is the total production expressed in terms of BOE. That was early in the quarter. The summer in North America is traditionally a time of seasonal weakness, particularly in gas pricing, obviously as the weather improves. This year we saw pretty good improvements in gas due to air conditioning load, and oil. The summer driving season started, and generally good prices, strengthening prices overall. Unfortunately, this opportunity had both an income and a substitution effect on our potential windfalls, as they were crowded out by sort of partner issues. The slide in front of you should show the events which we had, not too much warning, but materially impacted our numbers. If we back out those outages, we would have recorded at least another 400,000 US in revenue, which would have been particularly transformational to our bottom line, and critically underlines the opportunity for shareholders going forward. The downstream business, like our upstream business, has been challenged by what has been until now sort of an 8-year journey since 2014 to hell and back, and we received a second blow in the form of COVID. The good news is that the people of North America, which is the first OECD country to really recover from the pandemic, still need to fill their petrol tanks, cook food, produce petrochemicals, and start to go on road trips, and domestic aviation is ticking up markedly. At AXP, we've incurred the impact of several refinery and gas outages that limited our sales below what I would call normal outcomes of that 2,300 BOE per day. And you can see it in the graph. Most of this is the impact of the industry coming off the bottom and managing production tie-ins and deferred maintenance. We think this is a situational challenge rather than an ongoing one, particularly in light of the energy markets and pricing. And we've not seen the same level of volatility in July to date, which is encouraging for the September quarter. Alex, could we please have slide 6? The gap between perception and reality in terms of where AXP was and where we are today is massive. Right now we have a firm inventory of an additional 145 wells with productive capacity that will be bringing back online in the current and future quarters. In addition, we've got another 75 wells under review that will either be brought online with or without workovers, or abandoned based on our technical and geological evaluation. Beyond this, we've scheduled about 140 uncommercial wells for plugging and abandoned. 13 will be done this year and a further 13 in the next year. The heart of business is in the US, states that recognise the need for managing end of life for wells in a commercially acceptable manner. And as we've said many times, the abandonment retirement liability is very manageable, with most wells in this category being in the sort of $5,000 to $10,000 per well range, and we'll be prosecuting this activity on a regular and opportunistic basis. And you've heard us comment earlier that some views expressed publicly that with the MHP transaction, AXP bought a large portfolio of wells that are sub-economic or not productive on leases that are running out of gas. This really could not be further from the truth, as this slide demonstrates. Our well inventory has enormous upside potential, and the R&R report that we plan to release later this month will show the oil and gas resource that we have in place. And I would take this opportunity to reiterate that our well abandonment liabilities are limited to 10 wells per year, and that's a signed agreement that we have with the state of Kentucky. So contrary to some commentary, there's not some huge onerous financial burden hanging over us on P&A liabilities. Could we have the next slide, please, Alex? No, I was just going to say, following on, at AXP, part of our new conversation internally is we're not in the energy business, we're in the money business. And we intend to vacuum all the lost value, all the bypass reserves, we want to identify and exploit all the possibilities of our developing scale, irrespective of the size of our business, to deliver bottom line value. We presented our workover and production optimization operations as a discrete activity. Increasingly, this will be a feature of what we do across the productive and potential reserve portfolio. And you can anticipate ongoing efforts in this respect to maintain existing and unlock future production across our assets. We have exploration upside across the acreage, particularly in certain areas in the Appalachian Basin and Illinois Basin. And we'll address these as soon as we can, but our focus right now is on extracting more of the oil and gas that we've already identified. Next slide, please, Alex. So we've talked a lot in recent times about the KJ project. I think we had an announcement earlier in the quarter. It's brought some 26 wells into production following the decommissioning of some local coal mining operations. Nearby, we have another 31 wells which have been offline since 2016 that will tie in on the back of that. And looking forward, we have a moving target of around 129 wells that can benefit from intervention and or optimization. So across the company, we've inherited the consummate fixer-upper with really no shortage of opportunities for improvements, and we're finding, you know, more and more opportunities as we go. And we are very convinced that we have the team to deliver that. You know, you'll be hearing more and more about these little projects. The KJ pipeline is a great example of what the team identified as they, you know, I guess were freed up from the oppressive yoke of a big company bureaucracy being montage, and the project threshold ROIs that, you know, fall beyond those large companies' restraints. And as the energy transition progresses and community values evolve, the ability of companies like ours to deliver cash flow and bottom line contribution is going to be critical. And, you know, we understand that we need to bring cash flows forward and deliver now, and that's exactly what we're doing with this sort of project. Slide 9. Are you able to take over, Simon?
Yeah, yes, I am. Yeah. Apologies for the outage earlier. I've got an unreliable internet connection. So really, as taking over from what the picture that Sam's painted, as you boil everything down, our story is really about driving top line growth and improving margins. We've shared some early success, but, you know, holistically, we intend to work both ends of the game. We really want to grow our production profile organically, and we're going to be systematically attacking the cost base, as we've said many times publicly. So looking back at the second quarter, we've given ourselves a hard mark in relation to cost and cross-pollination at the bottom of the list in front of you. We barely made a pass in pricing and inventory sell down, but we're pretty pleased with the mitigation steps that we've put in place against future production outages. You know, our plan is to continue to integrate the reserves of recent asset additions, and we expect to produce a report, as Sam said, in that regard before the current quarter's out. Not listed here, but a recurring feature of Sam and my dialogue with the management team in Lexington, led by Tim, is sharing knowledge and realising economies across the enterprise. Another item is the constant monitoring some interesting developments in the broader energy space that may allow us to monetize otherwise stranded resource and to position AXP to benefit from, you know, what we think is a deep theme shift towards consolidation of productive capacity in the basin, and also possibly vertical integration of the supply chain, you know, if and when that makes economic and strategic sense. Next slide, please, Alex. So we wanted to finish with this slide because it really encapsulates our emerging philosophy and approach to opportunities in the sector and how we run the business. You know, we intend to be disciplined and we intend to be rigorous. So our name change reflects a shift in the centre of gravity of our asset base, shareholder expectations, but also perhaps more fundamentally in our strategy. So AXP is an energy company. We are now more focused on production than exploration. That said, some high impact vertical wells may not be out of the question, but we're also casting our eye into new corners that are enabled by our agility, our assets existing, that is, and also the infrastructure that we have in place. So the future for entities like ours, I believe, will be more complex than before and will likely extend beyond conventional production, and will address a myriad of possibilities that can traverse everything from carbon capture and storage through to in situ power generation technologies. So you need to stay tuned for more news in this regard, but we believe that there'll be some coming shortly. So next slide, please, Alex. So lastly, here are our contact details. Should you wish to communicate directly with Sam, myself, and Tim Hart, but please bear in mind that he is on the other side of the world. I would like to remind everyone that we're committed to fulfilling the continuous disclosure requirement that we face as an Australian incorporated entity listed on the ASX. We have to share information equally with all shareholders, but we also welcome the opportunity to communicate with people and corporations who've placed their invested funds in our stewardship. So that said, let's address the questions that we've received so far during the webinar so we can add some colour to the improving industrial picture for AXP. So over to you, Alex.
Thanks, Simon. And thanks everyone for your patience. Managed to weed out those minor little technical difficulties and still managed to push forward. Simon, the first question I'd like to address to you, if I can. AXP seems to have a lot of wells that return a great revenue that could return great revenue streams for a very low cap company. Based on the strategy of acquiring assets rather than tenements and drilling, what chance of a future dividend and what sort of revenue would you see necessary to declare a dividend?
Yeah, well, firstly, let me state that producing a sustainable, regular dividend to shareholders, that is, that is the end goal for us. At the moment, we're still, we're yet to record a quarter of what I would call, stable production. We're still in the process of determining the productive capacity of the wells that we have in our inventory today, and also ones that we're looking at to tie back in. So, I think there's a big gap between where we are today and that, that potentiality. But, I think that we think that it's very, very important to be focused on that as an end goal. And that's, part of what people expect as we shift our focus from, exploration and appraisal drilling, which was the case when we were focused solely on Colorado, and what we have today, which is a large in-basin position there in the Southern Appalachian and Illinois basins that we're looking to sort of build and develop. So the short answer is, are we looking to deliver a dividend? Yes, we are, but we're a long way from there today. But absolutely, people should see that as an end result of everything that we're doing today in the past quarter and in coming quarters. But I can't give you a precise time frame when that's going to be possible at this time.
Thanks, Simon. Sam, I'd like to address the second question, if I can, to you. Given the recent quarterly results, is there a plan for a share buyback to reduce the number of outstanding shares as this breaks open the OTC market?
Yeah, good question. The OTC market is something that we are actually focusing on right now. For those shareholders in the US, for our Australian shareholders, it's the US listing code is AUNXF. And it's been good to see some trading through there recently. In terms of a buyback, I think our priority, as Simon said, would be paying dividends before a buyback, but that's a little way off. What we're doing with our OTC listing is upgrading it to OTCQB or QX, which is an upgrade from the current pink sheet status, and that's in process now. That will be another 2 or 3 weeks before that's done.
Thanks, Sam. So I think you may have actually wandered somewhat subconsciously into the third question, which, can you address the upcoming SEC Rule 15C2-11 and how that may impact AXP from trading with major brokerages? As you may have mentioned there, and correct me if I'm wrong, but I believe the rule pertains to no pink and shell companies, and it seems like a lot of OTC retail traders are concerned about the rule. Could you just talk about or dispel any myths about buying OTC securities?
Yeah, sure. I mean, as I said, it's a focus for us, and we are seeing some more trading there emerging. I think 14 million shares went through there last night. So it is important that we understand the regulations in full. As we understand it, that particular rule is meant to bring those pink sheet companies which have little or no publicly available information into line, whereas we have a full set of information required under that SEC rule publicly available via the ASX. And the rule actually puts the onus, that rule puts the onus on the US broker dealers to have reviewed that information. So as we understand it, by complying with the ASX listing rules, we actually are in compliance with that rule.
Thanks, Sam. Simon, I might address this one to you. Sam, by all means, jump in if you think you can answer it as well. Can you tell us fairly simply what you're making per barrel of oil equivalent? I understand you have this mix of gas, natural gas liquids and oil, but what are the margins?
Sure. Look, it's moving around a little bit because what we sell a BOE for changes every quarter given the hydrocarbon mix, and there's been quite a few changes in the ratio of gas to near gas liquids and oil, of course. So, but for March through May, so 3 months, it was around about $7, which is still too low in our view. So, we've stressed today we are gradually improving the cost base and increasing this number. Increasing this number is our number one priority and focus. But the ways that we're doing this, we set out in the presentation. What I will stress is we're just 1 quarter in with MHP as part of our business. We're still finding ways to reduce costs and improve margins all the time, and that's going to continue into the future. As I said, we're now in the cash generation business, and this is the number one focus. So it's good to see some small wins like reducing transport costs, which we've previously announced. But you'll certainly see more in the next quarter or two.
Thanks, Simon. Now, you've talked about these leases having lots of upside, and the fieldwork is yielding some modest gains. But what can you do to really ramp up production levels?
Yeah, well, what we're doing today is just fixing what we have. That's a combination, bringing wells back into service that was, switched off, if you like, and production optimization in the field. So we're funding this internally, and our team's, doing the work with our own equipment. So once we achieve this, we'll look at, higher cost, higher impact frac jobs, deepening wells, more complex workovers and the like. So for example, our team's identified some workovers that would cost around about $250,000 US that could yield an additional 1 million cubic feet per day in gas production. So, there's a lot of these opportunities here and in TREY also, but it's about using our capital wisely and catching the low-hanging fruit first.
I think just to add on very quickly to the end of that, the focus is also for these programs to be funded internally from operating income. And that's what we've been able to do, and that's what we see we'll be able to do in the near term.
Thanks, Sam. Now, Simon, TREY seems to have fallen off the radar. Is it a focus for you, or is it just another disappointment?
Well, fair question. TREY has not performed to our expectations, I think it's fair to say, but it's not become a very big focus for us. And we are deploying more resources to it. Most of our focus has been on the MHP assets right now. So it has sensational upside, and I don't say that lightly. We bought TREY for its oil leases and productive potential. As we've flagged before, there's some old Exxon leases here with lots of recoverable oil and other adjacent leases that are even better. So TREY's leases are central to AXP really, developing its oil production profile, and we're working on that now. So our team in Lexington, the technical guys, will be diving into TREY very soon. They're just getting their arms around it. But from a basin perspective, there's a lot. We're not the only people interested in what's happening in that area. There's a lot of our peer group competitors who are also focused on that geology. So that looks quite interesting.
So, Simon, is the gas offtake in Colorado still alive?
Yeah, look, it's still on the table, but we're now looking at a number of options for Colorado, and I alluded to this, and Sam and I alluded to this in the presentation. What I will say is the board today has carefully assessed the off-take opportunity. We've measured it against where we get the best return on investment, deploy more money into Kentucky, or spend a lot of time on CapEx on a gas project that doesn't exactly achieve the margins we want to deliver. So on Colorado, we expect to provide an update to shareholders in the near future, but the focus of the organisation presently is really in Kentucky and the adjacent states right now.
So, Simon, speaking a bit more broadly now, what is the next biggest goal for the business to grow significantly?
Well, I mean, especially based on what we've shared with you today, really what we want to do is to see some, repeatable, stable production across all of the existing assets. We're going to continue to work the margins. We're going to continue to work the cost piece. There's a long list of very small things that in and of themselves are rather, discrete, digestible activities, but the totality of that, we believe will continue to keep most of our curves moving up to the right-hand corner. So really it's about bedding in what we have. We're taking functions in-house that were previously outsourced at higher cost. There's and we continue to look at surveil opportunities for further growth outside of our existing asset base. But really now it's about getting the business to perform with what we have and to work our way through this this internal inventory of performance improvement.
Thanks, Simon. I'd like to throw this over to Sam if I can. How are you able to mitigate against a repeat of downstream production and transportation interruptions?
Well, we had interruptions on both sides, on gas and oil. On the oil side, it was really a logistics issue with the transporter that was contracted by the refinery. We have brought that function in-house and we now have our own capacity, our own transport. So we don't, I mean, that's something we control. So we don't anticipate that being a problem going forward. In fact, we have, overcapacity in our ability to transport to the refineries now. On the gas side, it was the gas processing plant was bringing in a large producer during sort of late May and June, and that caused significant downtime in the plant, and that is now sort of stable, and that producer's running their production through, and we don't anticipate, I mean, there'll always be, I would qualify this by saying this is a complex plant, and we never say never, but we don't anticipate that those sorts of problems, are going to occur in the future.
Thanks, Sam. Now, Simon, I'll throw this one back to you if I can. With governments pushing for cleaner energy in the future, how do you think this will have an impact on the business?
Well, I think there's two elements to that. The first of all is the expectation on shareholders to be more mindful of your impact on the environment. That continues to be an everyday operational focus for our teams in the field. But I do think that there's a developing suite of technologies that are focused on reducing the carbon footprint of our business and the emissions that we produce. I mentioned earlier carbon capture and storage. There's a lot of things in that space that might be relevant to people like ourselves with productive infrastructure and the ability to sequester pollutants beneath the surface of the land. So that's one opportunity. I think in terms of where we sit in the United States, in Kentucky, at the heart of our basin footprint, we have a very good regulator who supports our business and supports what we do. A lot of focus on the energy transition, frankly, is doesn't consider the distance between where we are today and where we need to be in terms of how we generate energy for the planet. So we believe that our business will continue to be an important part of that transition. As Sam said before, that we have a supportive regulator in terms of our P&A liabilities. but they also are very, very keen to see us continuing to reticulate gas and deliver oil to the refineries, so that people can go about their lives and live in cool homes in the summer and warm homes in the winter. So, I think the reality is that most of our production today is gas, and that is relatively cleaner than oil. Most of the electricity in Kentucky today is generated by coal-powered power stations. So, insofar as the local reality in terms of how that energy is generated, we already are a much cleaner option than the heart of the electricity that's delivered to homes.
Simon, with MHP coming in, do you have many duplicate costs that you can strip out?
Yes, no, we've identified a lot of commonalities across the operation where we can achieve economies by, for example, we can use 2 guys to do jobs that were previously performed by 3, for example. So there's, in a lease operating expenses line, there's a lot of opportunity to, deploy people to do things more efficiently with, fewer resources. We are also seeing that the team that we inherited at MHP are a tremendous asset in terms of realising some of the potential in the smaller assets, and we're continuing to deploy those people, as we said, to deal and address technical and operational challenges in the TREY asset, for example. So yeah, there's so many things that we are addressing in that regard every day, and we think that'll be a continuing source of improvement as we sort of move forward into coming quarters. At the moment, we're kind of resource constrained. We have a very, very, very long list of things where we can save money, where we can improve outcomes and be more efficient. So, I mean, MHP has given us resources, but it's also given us an economy of operating scale. And we think that with as I say, principally the people that we've inherited with that acquisition, that places us in a very good position to be able to do more things in-house at a reduced cost to using external service providers.
If I can just chip in with a quick example, on the cost side, we've talked about some projects on the revenue side. An example of one of the things we're doing on the cost side is when we took over MHP, we also took over the finance function is being outsourced. We have a project in place at the moment to bring that function in-house. It's not a short project; it'll take some months. But I mean, just bringing the finance function in-house will save us probably $50,000 a month or more. So, we're looking across the board.
Thanks, Sam. Simon, can you just talk through why isn't the oil inventory dropping? Would it not be better to sell this and strengthen the cash base? And further to that, what do you think is an acceptable inventory level?
Yeah. Well, I mean, we produced a lot more, we sold a lot more oil in the quarter than the opening and closing inventory, would suggest. So there's a little bit of a, distortion through the quarter there as we stepped up our oil production to defray the impact of the reduction in gas. So, our goal at the moment is to be opportunistic about where the commodity price is at. We have probably a greater inventory on hand today than where we would like to be. It serves as a very good cash buffer for the business. If we do encounter some operational outages or headwinds, it does give us the ability to realise some money if we need it for organic projects. So the short answer I would say is that we don't have a target in terms of inventory level per se, but we do concede that it's probably somewhere below where we are. We've done a lot of work through the quarter, which we announced and shared with the market, to improve our offtake capability in the form of adding more trucks and drivers and the way in which those services are provided. So we have the ability now to be a lot more flexible about how we draw down on that inventory. But yeah, we're still continuing to draw down on it, and I think in the next quarter you should see that come down substantially.
Simon, do you see gas volumes increasing as the US heads into winter?
Yeah, typically there's a seasonal fluctuation. The gas price has been surprisingly high this year through the summer period. We expect that there is a potential for it to trend higher as we approach the colder weather. Yeah, that's typically been the historical experience in the gas market in the lower 48. Yes.
Just a couple more questions to finish off with. Simon, can you give us a flavour for the options you have for Colorado?
Yeah, I can. It's about monetizing the gas. We have looked at, conventional opportunities to produce that gas. As people would be aware, there's limitations on gas flaring in Colorado. Our project there is not just gas; it's also oil. So the priority for getting rid of that gas is to unlock the greater revenue production associated with the liquids beneath the gas cap. So we've been looking at reticulating that power to industrial users. There is a pipeline on the area, but it's so far from the field that there's an economic threshold that we've not been able to cross. And we have some other interesting ideas how we might exploit that gas, but I can't talk too much to them at the moment because it's a developing situation, but we believe that we'll have some interesting news for the market in that regard very soon.
Thanks, Simon. Just one last one for Sam. With the gas outages that you had, did that also crimp oil production?
Yes, it did, because with gas production, there's associated oil production. So when gas production drops, so does oil. If we have to shut in wells, we shut in oils. So growing daily oil production will come, with more reliability downstream on the gas processing side.
Thanks, Sam. And just one final one for you, Simon. You mentioned power generation. What type of generation, gas-fired, portable type or scalable permanent type? What are we sort of talking about here with regards to power generation, and what timeline would you expect?
Yeah, well, let me be clear. We have no immediate plans to become a power producer. What we're looking at doing is seeing, how we can, exploit our position in the basin to, reticulate more gas. So, I think we're more likely to, consider opportunities around some of the compression infrastructure and, tolling gates than we would about actual, generating power. I was talking more generally about, the, community, broader community, stakeholder environment in relation to the, the emission signature of gas versus coal. So to be clear, I should clarify that, we're not talking about going into the power generation, business on a large industrial scale. There may be opportunities, discrete opportunities to use, some of the stranded gas across our inventory for, an industrial provider, etc. But at this stage, I don't think there's much for us to say in that regard. We're more on the production side than the power generation side for the time being. But that could change.
Thanks, Simon. Look, I just wanted to let's cut it there. I think we've that's all the time we have for today. I'd like to thank you all for joining me, and I also like to thank Simon and Sam for presenting and taking the time to answer some questions. As I mentioned before, recording the webinar will be on AXP's social media platforms later today. Simon, before I let you go, do you have any final comments to leave with us today?
No, just in summary, I'd like to thank everyone for continuing to have faith in what we're doing at the company. It's been a dramatic change in focus. We've really pivoted from being an exploration-focused company to a production company, and we're at the very early stages of realizing the opportunity set that comes with that. And I'd just also like to say that as we work our way through the opportunities, there's going to be a steady diet of information and announcements to come in current months. And we're very pleased with what we're seeing so far, and what's happening every day in the field. And I'd like to thank everyone again for their faith in the company, and I'd also like to thank all of our employees as well, who are making this journey possible.
Fantastic. Thanks, Simon. Thank you, Sam. And thank you all for joining us today. Look forward to any further questions. Feel free to keep sending them through. But as always, thanks for joining me, and all the best. Have a great day, everyone. Thank you.